Silver just crossed $94 per ounce, a 32% surge since January. But here's what they're not telling you. The gold-silver ratio dropped to 51.33. The last time it moved this fast, fortunes were made and lost within weeks. Central banks have been quietly positioning. Industrial demand is breaking records. And options traders, they're preparing for something bigger. The question isn't whether you're paying attention, it's whether you'll recognize the warning signs. Before the consolidation hits, beat. Welcome to John Analyst, where we decode the markets before the crowd catches on. Now, if you've been watching silver, gold, or any precious metals, and you value straight analysis over noise, do yourself a favor. Hit that subscribe button. I know. Everyone asks you to subscribe these days, but think of it this way. Would you ignore your broker's call during a bull run? Exactly. So subscribe. Stay informed. Stay ahead. And tell me, where are you watching this from today? New York? London? Mumbai? Singapore? Drop your city in the comments. Let's see who's paying attention across the globe. Now, let's break down what's really happening with silver. Thursday's trading session delivered a jolt to precious metals markets that cannot be dismissed as routine volatility. Silver closed at $94.14 per troy ounce, marking a 1.61% single-day advance from Wednesday's $92.64 level. While percentage moves of this magnitude may appear modest in isolation, the broader context reveals a market operating under extraordinary pressure. The year-to-date performance tells a more complete story. Silver has surged 32.43% since January 1st, a gain that places it among the top-performing assets across all major commodity categories. This is not incremental appreciation. This is a sustained, powerful trend that has caught the attention of institutional allocators, hedge fund strategists, and sovereign wealth managers worldwide. To understand the significance of this move, one must examine the gold-silver ratio with precision. On Thursday, this critical metric stood at 51.33, down from 52.10 just one day prior. For those unfamiliar with this relationship, the ratio measures how many ounces of silver are required to purchase 1 ounce of gold. A declining ratio indicates silver is strengthening relative to its monetary cousin. Historical analysis provides crucial perspective. Throughout the 2023 to early 2025 period, this ratio frequently traded above 80. At certain points during that window, it even breached 85, signaling extreme undervaluation of silver compared to gold. The current reading of 51.33 represents a dramatic compression, one that suggests silver has been outperforming gold at an accelerated pace. This compression matters for strategic reasons. When the ratio falls to these levels, it historically signals one of two scenarios. Either silver has become overextended and is due for consolidation relative to gold, or gold itself is undervalued and preparing for its own advance. Market participants must determine which narrative will dominate in the weeks ahead. Three primary forces are driving silver's current price structure. The first is the geopolitical landscape. Escalating tensions across multiple theaters have renewed interest in tangible assets that exist outside the traditional banking system. Silver, like gold, offers protection against currency instability and political uncertainty. When confidence in fiat systems wavers, precious metals attract capital flows. The second force is the interest rate environment. Central banks across developed economies have been navigating a delicate path between controlling inflation and supporting economic growth. The Federal Reserve's policy decisions ripple through all asset classes, but precious metals respond with particular sensitivity. Lower interest rates reduce the opportunity cost of holding non-yielding assets like silver. When Treasury yields compress, silver becomes relatively more attractive. The third force is the US dollar's strength. Silver prices maintain an inverse correlation with dollar performance. When the greenback weakens against major currencies, silver typically rises in dollar-denominated terms. Thursday's price action occurred against a backdrop of modest dollar softness, amplifying the metal's advance. Yet these three factors alone do not fully explain the velocity of silver's ascent. Something structural has shifted beneath the surface of this market. The speed of the move from 92.64 to 94.14 in a single trading session, combined with the year-to-date surge, suggests forces beyond traditional safe haven demand are at work. Volume analysis from Thursday's session reveals elevated participation across both physical and paper markets. Exchange-traded funds tracking silver saw significant inflows. Futures market open interest expanded. Physical dealers reported increased inquiries from both retail and institutional buyers. This is not speculative froth. This is broad-based demand responding to fundamental shifts. The question facing market participants is whether 94.14 represents a sustainable price level or a technical extreme vulnerable to sharp reversal. Precious metals have a documented history of explosive advances, followed by equally violent corrections. The 2011 silver peak, when prices briefly touched $50 per ounce before collapsing, remains fresh in the memory of veteran traders. However, the current environment differs in critical ways from 2011. The rally then was driven predominantly by speculative positioning and momentum-chasing behavior. Today's advance is supported by structural factors that were absent 14 years ago. Industrial demand has become a significant component of silver's supply-demand balance, a dynamic that did not exist to the same degree during the previous cycle. Silver's dual nature, both industrial metal and monetary asset, creates unique price dynamics. Understanding these dynamics requires examining the industrial consumption patterns that now underpin a substantial portion of global demand. The solar panels being installed across rooftops in California, the electric vehicles rolling off assembly lines in Shanghai, and the smartphones being manufactured in South Korea share one critical component that most consumers never consider. Silver, not as decoration, not as luxury, but as an irreplaceable conductor of electricity that makes modern technology function. This industrial reality has transformed silver from a purely monetary metal into a strategic industrial commodity. The implications for price discovery are profound and largely underestimated by traditional precious metals analysts who remain anchored to outdated frameworks from decades past. In 2024, global industrial consumption of silver reached levels that shattered previous records. The solar energy sector alone accounted for a 15% increase in silver demand compared to 2023. This was not a temporary spike. This was structural expansion driven by government mandates, corporate sustainability commitments, and the basic physics of photovoltaic technology. Silver paste remains the most efficient material for conducting electricity in solar cells. No viable substitute exists at scale. The electric vehicle revolution has added another dimension to industrial silver consumption. Each EV contains approximately twice the silver content of a traditional internal combustion vehicle. Battery management systems, charging infrastructure, and power electronics all require silver for optimal performance. As global EV production accelerates, silver demand from this sector compounds year over year. Electronics manufacturing continues to consume vast quantities of silver despite decades of miniaturization efforts. Circuit boards, switches, and connectors rely on silver's superior conductivity. The proliferation of 5G networks, data centers, and artificial intelligence infrastructure has actually increased silver intensity per unit of GDP in developed economies. Technology is not reducing silver demand. It is amplifying it. Geographic consumption patterns reveal where industrial demand is most concentrated. The United States, despite its reduced manufacturing base, still consumes substantial silver through its remaining electronics and defense industries. Military applications alone represent a significant and largely opaque source of demand that operates independently of price signals. China's manufacturing dominance makes it the single largest consumer of industrial silver globally. The country's production of solar panels, consumer electronics, and electric vehicles creates constant demand that must be met regardless of price fluctuations. Chinese industrial buyers do not speculate. They purchase based on production schedules and cannot easily substitute away from silver without redesigning entire manufacturing processes. India presents a unique dual demand profile. Industrial consumption has grown as the country expands its manufacturing capabilities and renewable energy infrastructure. Simultaneously, India maintains one of the world's largest markets for silver jewelry and traditional ornamental uses. Cultural demand during wedding seasons and religious festivals creates predictable spikes that overlay industrial baseline consumption. This combination of industrial and cultural demand creates a price floor that did not exist during previous silver bull markets. In 2011, when silver reached $50 per ounce, the rally was driven almost entirely by investment speculation and momentum trading. Industrial demand was present, but not structurally significant enough to prevent a collapse when speculators exited. Today's market structure is fundamentally different. Even if investment demand were to evaporate overnight, industrial consumption would continue absorbing substantial quantities of annual mine production. Solar manufacturers cannot pause production because silver prices rise. EV factories cannot halt assembly lines because silver becomes expensive. This creates downside protection that previous generations of silver investors could not rely upon. The contrast between 2011 and 2025 extends beyond demand composition. In 2011, mine supply was expanding rapidly as producers responded to high prices. New projects came online. Existing mines increased output. Supply elasticity helped cap the rally and contributed to the subsequent crash. Current supply dynamics tell a different story. Major silver-producing regions face declining ore grades, rising extraction costs, and permitting delays that prevent rapid production increases. Peru, Mexico, and China, the three largest producers, are all experiencing challenges in maintaining, let alone expanding, output. Primary silver mines are rare. Most silver comes as a byproduct of copper, lead, and zinc mining. When base metal prices are weak, silver supply contracts regardless of silver's own price. The safe haven characteristics that silver shares with gold add another layer to its appeal. During periods of financial stress, both metals attract capital-seeking preservation rather than speculative gains. Silver's lower price point compared to gold makes it accessible to a broader range of buyers. A middle-class family in Asia can accumulate silver bars. A pension fund can allocate to silver ETFs. This democratization of access creates diverse demand that is difficult to disrupt. Portfolio managers increasingly view silver as a diversification tool that provides exposure to both precious metals and industrial commodities simultaneously. This dual classification allows silver to perform in multiple economic scenarios. In deflationary environments, its monetary properties provide stability. In growth periods, industrial demand supports prices. Yet beneath this structural support lies a question that will determine whether $94.14 proves sustainable. Is industrial demand growing fast enough to absorb not just current mine supply, but also the investment flows that have entered the market? If monetary policy shifts unexpectedly, if central banks pivot toward tightening, if recession fears materialize, will industrial consumption alone be sufficient to maintain these price levels? The answer to that question depends on understanding the monetary policy framework that has enabled this rally. On September 18, 2024, the Federal Reserve made a decision that would reverberate through precious metals markets for months to come. The first interest rate cut in over 4 years. Not a modest quarter-point adjustment, a full 50 basis points. The signal was unmistakable. The era of restrictive monetary policy had ended. What followed was not immediate chaos or panic buying. Markets rarely move that simply. Instead, a gradual recalibration began across asset classes as investors absorbed the implications of a central bank that had blinked first. The dollar softened incrementally. Treasury yields compressed. And silver began its quiet ascent from the low 80s toward territory it had not occupied in over a decade. The Federal Reserve did not act in isolation. The European Central Bank had already initiated its own easing cycle months earlier. The Bank of England signaled dovish intentions. The Bank of Japan, trapped in its own decade-long policy experiment, maintained ultra-loose conditions. A coordinated global easing environment emerged, not by explicit agreement, but through synchronized responses to similar economic pressures. For non-yielding assets like silver, this environment creates a fundamental shift in relative attractiveness. When a 10-year Treasury note yields 4.5%, holding physical silver carries a substantial opportunity cost. That yield represents guaranteed income foregone. But when the Fed cuts rates and bond yields fall to 3%, then to 2.5%, the opportunity cost shrinks. Silver's lack of yield becomes less penalizing. The mathematics of this relationship are straightforward, but the psychological impact runs deeper. Lower rates signal central bank concern about economic growth, financial stability, or both. When the institution responsible for maintaining economic equilibrium begins easing aggressively, it validates fears that many investors harbored privately. Suddenly, allocating capital to hard assets that cannot be printed, debased, or manipulated through policy decisions seems less paranoid and more prudent. Inflation dynamics added complexity to this calculation. Throughout 2023 and early 2024, central banks had raised rates aggressively to combat inflation that reached levels not seen in 4 decades. By late 2024, headline inflation had moderated from its peaks. Official statistics showed progress, yet real-world inflation, the prices people actually paid for, housing, healthcare, food, and energy, remained stubbornly elevated above pre-pandemic norms. This disconnect between official inflation measures and lived experience created skepticism about central bank claims of victory over inflation. If inflation truly was defeated, why did the cost of living continue rising faster than wages for most households? The answer, many concluded, was that inflation had merely shifted from acute crisis to chronic condition. Base effects and statistical adjustments could mask the problem in official data, but grocery receipts and rent checks told a different story. Silver historically functions as protection against exactly this type of environment. Not hyperinflation, not crisis, but persistent erosion of purchasing power that compounds silently over years. An ounce of silver bought in 1970 for $1.50 could purchase a week's worth of groceries. That same ounce at $91 today purchases roughly the same amount of food. The nominal price changed. The purchasing power relative to basic goods remained relatively stable. This preservation characteristic explains why investors began rotating capital toward precious metals as rate cuts commenced. The Fed's easing cycle signaled that inflation would not return to the 2% target anytime soon. Real interest rates, nominal rates minus inflation, remained negative or barely positive in most developed economies. Under such conditions, holding cash meant accepting guaranteed purchasing power erosion. Holding bonds meant accepting minimal real returns. Holding silver meant maintaining optionality. Currency debasement concerns amplified these dynamics. The United States national debt surpassed $35 trillion during 2024. Annual deficits continued running above $1 trillion despite a supposedly strong economy. Similar patterns emerged across Europe and Japan. The mathematical reality was inescapable. This debt would never be repaid through austerity or growth. It would be inflated away through currency debasement. Silver's role as an alternative store of value gained credibility as these fiscal trajectories became impossible to ignore. Unlike fiat currencies that could be expanded infinitely through central bank balance sheet operations, silver existed in finite quantities. New supply came only from mining operations bound by geological and economic constraints. This scarcity provided implicit protection against monetary dilution. The historical precedent was clear. Every major period of monetary expansion and currency debasement throughout history had corresponded with rising precious metals prices in nominal terms. The 1970s stagflation era, the post-2008 quantitative easing period, the COVID-era stimulus programs. Each episode validated silver's utility as a monetary hedge. Yet this same monetary policy framework that enabled silver's rally to 94.14 contained the seeds of potential reversal. Central banks remained data-dependent. If inflation proved more persistent than anticipated, if wage growth accelerated beyond expectations, if financial conditions loosened too much, the Fed could pause its cutting cycle, or worse, signal that further cuts were off the table entirely. Such a policy pivot would eliminate the primary tailwind supporting precious metals. Real interest rates would rise. The opportunity cost of holding silver would increase. Investment flows that had driven prices higher could reverse with stunning speed. The very policies that created the conditions for this rally maintained the power to end it. Market participants were not blind to this risk. Options markets reflected it clearly. Implied volatility on silver options had surged to levels typically associated with crisis periods or major trend reversals. Traders were paying substantial premiums for both upside calls and downside puts, revealing uncertainty about whether current prices represented a new plateau or an unsustainable spike. The put-call ratio showed sophisticated players implementing hedging strategies rather than making directional bets. Professional traders recognized that while the trend was strong, the foundation was vulnerable to policy shifts that could materialize with little warning. A single hawkish speech from a Fed governor, an inflation print above expectations, a labor market report showing wage acceleration. Any of these could trigger reassessment. This created a paradox for investors evaluating silver at $94.40. The same monetary conditions that justified higher prices also created fragility. The rally was built on a presumption of continued easing, negative real rates, and currency debasement concerns. If those presumptions proved incorrect, the entire thesis would require recalibration. Understanding how traders were positioning for this uncertainty requires examining the options, market mechanics, and strategic frameworks being deployed. The options market reveals what words often obscure. When implied volatility on silver options climbs above the 60th percentile of its historical range, it communicates a singular message. Uncertainty has become expensive, and expensive uncertainty creates both opportunity and danger depending on how one chooses to engage. Out-of-the-money call options on silver, strikes positioned 10 or 15% above current prices, are trading at premiums that would have seemed absurd 6 months ago. A call option expiring in 30 days with a strike at 105 might cost $4 or $5 per ounce. That represents meaningful capital at risk for the right, not the obligation, to purchase silver at a level it may never reach. Yet traders are paying these premiums because the velocity of the current move suggests that improbable strikes can become profitable faster than traditional models predict. This is momentum pricing. When an asset rises 32% in a matter of months, options market makers must price in the possibility of continued acceleration. Standard deviation models break down. Historical volatility becomes less relevant than realized volatility over recent windows. The result is option premiums that reflect fear. Fear of missing further upside, fear of being caught short, fear that normal probability distributions no longer apply. For sophisticated traders, these elevated premiums create selling opportunities rather than buying imperatives. Cash-secured put strategies become particularly attractive in high implied volatility environments. The mechanics are straightforward. Sell a put option at a strike below current market price. Collect substantial premium due to elevated volatility. If silver falls below the strike, purchase the metal at an effective price reduced by the premium collected. If silver remains above the strike, keep the premium as profit and repeat the strategy. Consider a concrete example. With silver at $94.14, a trader might sell a put option with a $90 strike expiring in 3 weeks. In the current volatility environment, that option might fetch $2 in premium. The trader collects $200 per contract immediately. If silver closes above $90 at expiration, the option expires worthless, and the trader retains the full premium. If silver falls below 90, the trader must purchase at 90, but has already collected $2, making the effective purchase price $88. well below current market levels. This strategy converts elevated volatility from threat into income stream. It allows participation in the silver trend while defining maximum risk and collecting time decay. It is the approach of traders who believe the trend remains intact, but recognize that paying inflated premiums for long options is a negative expected value proposition. Bull call spreads offer another framework for risk-defined participation. Instead of purchasing an expensive at-the-money call option outright, a trader simultaneously buys a call at current prices and sells a call at a higher strike. This reduces the upfront cost by sacrificing unlimited upside beyond the short call strike. In a volatile market where options are expensive, this trade-off often makes strategic sense. Using the current price of $94.14, a trader might buy a $95 call and sell a $105 call, both expiring in 45 days. The long call might cost $6. The short call might generate $3 in premium. Net cost is $3 for a position that profits if silver rises, with maximum profit of $7 if silver exceeds $105 at expiration. This structure provides leveraged upside exposure while capping both risk and reward. Yet all derivative strategies operate under a fundamental constraint. They require accurate assessment of directional bias and time horizon. If silver consolidates sideways for weeks, even well-structured option positions can erode through time decay. If silver reverses sharply, protective strategies may limit losses, but cannot eliminate them entirely. Options are tools, not guarantees. The necessity of disciplined risk management becomes paramount when assets reach price levels that represent multi-year or multi-decade highs. Silver at 94.14 has exceeded every price point established since 2011. There is no recent price history to provide support levels. There are no obvious technical reference points that have been tested multiple times. This is uncharted territory, and uncharted territory demands caution. Stop-loss orders represent the most basic form of protection, yet their placement requires judgment rather than formula. Place stops too tight, and normal intraday volatility will trigger premature exits from positions that would ultimately prove profitable. Place stops too loose, and drawdowns can exceed risk tolerance before protective orders execute. In silver's current volatility regime, a 5% stop might trigger multiple times per week. A 10% stop provides more breathing room, but allows substantial capital erosion before activation. Professional risk managers often prefer options-based hedging over stop-loss orders for volatile assets. Purchasing out of the money, put options creates a defined floor under positions without the risk of being stopped out during temporary volatility spikes. A trader holding physical silver or ETF shares might purchase put options at $85 or $80, creating insurance against catastrophic declines while maintaining upside participation. The cost of this insurance, the put premium, functions as the price of peace of mind. Position sizing deserves equal attention. The temptation to overweight portfolios toward assets demonstrating powerful trends is psychologically overwhelming. When silver has delivered 32% returns year to date, the natural impulse is to increase exposure to capture more of the trend. This impulse has destroyed more portfolios than any other behavioral bias in financial markets. The prudent approach maintains position sizes that allow survival of worst-case scenarios. If silver were to experience a 20 or 30% drawdown over coming weeks, would the portfolio remain viable? Could the trader psychologically and financially withstand such volatility? If the answer is no, position size is too large regardless of conviction level. Critical monitoring points will determine whether silver's rally continues or enters consolidation phase. Industrial production data from major economies provides the first indicator. If manufacturing activity contracts, if solar panel installations slow, if EV production disappoints, industrial demand that underpins current prices could weaken faster than investment flows can compensate. Central bank commentary represents the second critical variable. Any hawkish shift from the Federal Reserve, any indication that rate cuts will pause sooner than markets anticipate, any suggestion that inflation remains problematic. These signals could trigger rapid precious metals liquidation as real interest rates adjust upward. The gold-silver ratio itself demands continuous observation. At 51:33, the ratio sits near the low end of its multi-decade range. Historical analysis shows that ratios below 50 typically do not persist for extended periods. Either silver consolidates while gold advances, bringing the ratio back toward equilibrium, or both metals correct, but silver falls harder, again normalizing the relationship. Ratios rarely remain compressed indefinitely. Technical resistance levels provide the final monitoring framework. Silver has broken through numerous historical resistance points on its path to $94.14. But overhead supply from traders who purchased at higher prices during the 2011 peak still exists. As silver approaches psychologically significant levels like $100 per ounce, profit-taking pressure may intensify. Round numbers create magnets for limit orders and psychological barriers that price action must overcome through sustained buying pressure. The probability of near-term consolidation cannot be dismissed. Assets do not rise in straight lines indefinitely. 32% gains over months represent extraordinary performance that typically requires digestion periods. During consolidation, prices chop sideways in a range, testing the resolve of recent buyers and flushing out weak hands before the next directional move emerges. For market participants, the strategic question crystallizes into a binary choice. Either current prices represent early stages of a much larger move, justified by industrial demand growth and monetary policy trends, or current prices represent an overextended advance vulnerable to sharp correction once momentum players exit. There is no middle ground at these levels. The evidence supports both interpretations. Industrial fundamentals remain robust, monetary policy remains accommodative. Currency debasement concerns remain valid. These factors argue for sustained higher prices. Simultaneously, the velocity of the advance, the compression of the gold-silver ratio, and elevated options volatility argue for caution and tactical hedging. What remains certain is that silver at 94.14 per troy ounce exists in a fundamentally different regime than silver at $60 or $70. The dynamics that drove prices from those levels to current heights may not be sufficient to drive prices from 94 to 120 or 150. Different phases of bull markets require different catalysts. Early stages reward conviction, late stages punish complacency. The coming weeks will reveal whether industrial demand growth, monetary policy trajectory, and investment flows can sustain prices at these elevated levels, or whether gravity reasserts itself and silver enters the consolidation phase that historical patterns suggest is overdue. Traders who survive bull markets are those who recognize that discipline matters most when conviction feels strongest.